The Fed's keenly awaited interest rate decision is due as we publish at 6 a.m. Sydney Melbourne time. That is the focus on markets. Although global bond yields were actually falling earlier this morning on weaker than expected jobs growth and slower than expected Eurozone inflation. That's coming up in our 5 Things in 5 Minutes. And then in our deep dive interview, ANZ senior commodities strategist Daniel Hynes takes a closer look at US President Joe Biden's momentous decision this week to pause the building of LNG export terminals in the United States, which will make European gas consumers nervous.
Now that they've pretty much stopped receiving most of the Russian gas they had previously been using. In fact, they've got to double their LNG imports over the next 5 or 6 years, and the US was going to be a key part of that.
But first, in 5 and 5 with ANZ, bond yields were falling going into the Fed's decision this morning, which is due at 6 a.m. Sydney Melbourne time. Lower than expected US payrolls growth and slower than expected Eurozone inflation dragged down US Treasury yields and German bond yields. They fell 10 to 15 basis points in the hours before the decision. The Fed is expected to hold the Fed funds rate in its current range of 5.25% to 5.5%. The main focus is reading the decision and then listening to Chair Jerome Powell in a news conference which starts at 6:30 Sydney Melbourne time to find out when the first cut might be. Expectations for a March cut actually firmed overnight to a 60% chance from under 40% the previous day. The 2-year Treasury yield, which is seen as a proxy for the Fed funds rate over the next 12 to 18 months, it fell 13 basis points to 4.22%. So that means the markets are expecting about 100 basis points of cuts over the next 12 to 18 months. The US dollar, therefore, nudged a bit lower ahead of the decision. The Aussie and Kiwi dollars were broadly unchanged at 5 a.m. Sydney Melbourne time at 65.96 US cents for the Aussie and 61.42 US cents for the Kiwi. Number 2, inflation data for the December quarter in Australia was weaker than expected yesterday, largely because of a 0.7% fall in tradables prices. Now that includes lower fruit, veggie, car and overseas holiday prices. However, domestic inflation, the non-tradable stuff, that remains problematic and was 1.3% for the quarter, says ANZ Australia senior economist Catherine Birch.
And actually the 6-month annualised rate is at 5.4%, so still very high. And non-tradables inflation is slowing a lot more gradually than tradables inflation is. And non-tradables inflation is much more affected by what's going on domestically. It's the part of inflation that the RBA has more of an influence on. So they'll certainly be keeping an eye on that. And that strength in some of the domestic pressures still suggests that rate cuts are still a while off.
Number 3, but will those rate cuts from the RBA be later in 2024 or earlier? Catherine sees yesterday's data strengthening the case a bit for slightly earlier cuts, although ANZ research still has the first one penciled in for November.
But that said, given that inflation is slowing a bit more quickly than the RBA had forecast, there might be some risks that we may see an earlier commencement of rate cuts. But it's unlikely the RBA would signal this at its meeting next week. And we are also still very aware of that strength in non-tradables and services inflation. The RBA will want to see both of those come in sustainably lower before they can be sure that inflation is going to return sustainably to their target band.
Number 4, there was some market reaction in Australia yesterday to the weaker than expected inflation, especially in interest rate markets, rather than currency markets. Here's ANZ rate strategist Jack Chambers.
We saw a big drop in rates and increase in expectations that the RBA will ease by year end. So prior to the meeting, markets had been pricing in about 40 points of cuts by the end of the year. They're now pricing around 60 following the data.
Number 5. Meanwhile, in New Zealand, ANZ's monthly business outlook survey of confidence found a mixed outlook. Confidence about the wider economy rose a bit, but confidence about businesses' own activity was weaker. Here's ANZ New Zealand Chief Economist Sharon Zolmer.
So it's good news that businesses are feeling more positive, but it is conditional. And that is, have we had enough pain to be sure that inflation is beaten? In this survey, we did see mixed bags on the inflation front, I would say. Inflation expectations did take a step lower from 4.6 to 4.3%, which is very welcome, though obviously still well outside the Reserve Bank's target band of 1 to 3%. But the proportion of firms expecting to raise their prices in the next 3 months, that's stubbornly high. It's stuck around the 50% mark. It really needs to get down to more around the 30% mark, has been what has been historically consistent with inflation in the band. So a way to go.
Sharon Zollner there. Now, in our deep dive interview, ANZ senior commodity strategist Daniel Hynes takes a closer look at Joe Biden's decision this week to pause the building of LNG export terminals. Daniel says it won't have much effect in the short run, but it's a big deal for the global LNG market, which was dominated by Qatar and Australia up until last year, when the United States became the market leader.
This is for projects which are in early stages of design, feasibility studies being done and the like. So this is a medium to longer term move, but it does present some question marks over place of LNG in the energy mix over the medium term, and also the Europeans would be a little bit nervous. They have a huge hole to fill in terms of their gas or LNG requirements now that they've pretty much stopped receiving most of the Russian gas they had previously been using. In fact, they've got to double their LNG imports over the next 5 or 6 years, and the US was going to be a key part of that. So that's going to represent, I suppose, a challenge for the Europeans as well. It obviously raises questions about the growth in supply of LNG, what the competing factors impacting that in particular. In this case, it's climate change issues which the Biden administration have raised as a concern over the growth of development in that industry. So it does I suppose present some challenges for developers now.
Could you put the US LNG terminals and the growth of exports of LNG from the United States into context of how much US gas was exported previously and the various competing exporters of LNG around the world, including Australia?
Yeah, I mean, the US market, has virtually grown from nothing only a decade ago. They did have, in fact, a complete ban on the export of energy at certain points. So, they're now looking at being one of the, if not the biggest exporter, competing with Qatar and Australia, as the world's largest exporter. So it's been quite a phenomenal shift, I suppose, in the energy mix, with the US now becoming a significant exporter in the global LNG market.
And how might Australia's fast-growing and very large LNG export sector, how might it view this change in the United States, or at least this pause in the United States?
Well, I mean, if we saw this export process result in even further delays, I think it does open up the opportunity for Australian LNG exporters. They have been looking on with concern about the growth, in other exporters such as Qatar and the US. And with prices falling just recently, the economics have been also questionable. So, this does represent, I suppose, a potential window for some of those developers to fill if we don't end up seeing the same amount of gas that some of these projects would have delivered.
Daniel Hynes there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, February the 1st. Catch you tomorrow with all the detail from the Fed's decision and Chairman Powell's news conference, which starts at 6:30 Sydney Melbourne time today. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.